Yes, hello everyone. Welcome to the next video. So moving on from GDP that we just covered right now, we're going to be moving on to inflation. Now, this is a term that many of you have probably heard since, you're in the industry of Forex, and inflation is something that affects every single consumer around the world. Whether, it doesn't matter which economy they're in, inflation always exists. So what is inflation? Inflation is the rate of inflation is the change in prices of goods and services over time. It can be described as a decrease in purchasing power of a currency. So the optimum level of inflation is considered to be 2%. So countries' banks will always aim to keep inflation around this level. If we see inflation become too high, the cost of products increases, and vice versa as well. So you see how we just said it decreases the purchasing power of a currency. To frame that in your mind, let's just say, for example, you've got 100,000 right now, and then inflation increases 10%. So that means if you were to buy something that costed 100,000 this year, but next year it would cost 110,000. That means your 100,000 has less purchasing power because due to inflation. And as you know, the effect of inflation is very significant, and it can cause many changes in monetary policies of a country to try and change and deal with this issue. As we discussed briefly in the economic train video, inflation could be, you know, it needs to stay quite stable to have a thriving economy, and too high of inflation can lead to hyperinflation, and that's very dangerous for an economy, as we've seen in Germany. So what are the causes of inflation? So the main one is money supply. The amount of money printed by a country is a significant factor in the cause of inflation. So think about it. The more inflation printed, the weaker the purchasing power, therefore a devalued currency. That's why when you look on the markets, if you see, whenever you see countries with higher inflation, they've always got a lower currency, a lower cost of the currency. So the pros and cons of inflation. And not all inflation is bad. Don't get that wrong. Just because the prices of things are going up doesn't mean it has a directly negative impact. If inflation is up, but so is the employment, so more people are getting employed and having jobs, more people are financially stable, so are the wages, so is GDP, and then it is a good effect. However, too much inflation in such a short time is detrimental to a country. As we explained here, an extreme example is hyperinflation, which is considered 50% inflation month on month. So between 1 month to the next, more than 50% is a crazy amount of inflation to see. Now, ultimately, this is what countries' financial regulators attempt to avoid. Their goal is to keep a steady inflation at 2% rate. So to really break it down, inflation and then going up and inflation going down, which is also called deflation. So when inflation is rising, the currency devalues. Purchasing power decreases, as we explained with that $100,000 example. Now, what happens when inflation increases? So exporters benefit as their goods are cheaper for foreign nations. So think about it, as their currency devalues, for other people to purchase that currency is cheaper for them, right? So any exports that we send internationally, it becomes cheaper for us. So there's going to be a higher levels of interest of other nations coming to buy products from us rather than others. Therefore, we become very competitive in the market, so we can put cheaper prices, and due to our cheaper prices, we become competitive. However, the opposite is also true. Importers are harmed as imports become more expensive, since foreign currency costs more of their own currency now. So as our currency and purchasing power decreases, it costs a lot more to get the same imports as it did before. Let's look at deflation now. So when inflation is down, also known as deflation, the currency increases in value. The purchasing power also increases. So you know how we said vice versa, when purchasing power decreases when inflation is up, purchasing power increases because our currency becomes stronger. Now, there's obviously benefits and consequences of both these actions. When deflation is occurring, exports are harmed since our goods are more expensive for foreign nations. And like we said, we become less competitive because other nations can provide cheaper goods for the, for international economies. However, our imports become cheaper. So you've got to weigh up these two factors, and just, every economy will have to weigh these two factors up and just see which works for them. Now, it depends on what type of economy you are. So if you're an economy such as China, for example, or Japan, that really exports a lot of products, in theory, what do you want? I mean, would you expect them to have a currency that is very strong, or a currency that is very weak? Now, to make imports cheaper, okay, that might be a bit of a problem for them. But what they want is they want their exports to be as cheap as possible. So essentially, they're the leading exporters in the world. So most people will flock to their economy to buy their goods. And we're going to be explaining this in much more detail when it comes to imports and exports, in some of the later videos in the core fundamentals, and then obviously in the advanced fundamentals as well. So there's not just one type of inflation. There's actually three types. Four, but three. These are the three main types. The first one is demand push inflation. Essentially, it's printing and demand, supply and demand. When the monetary policy increases, it stimulates more economic consumption, and thus demand is higher, leading to price increases. Then the second type, cost push inflation, higher CPI and PPI. So what, briefly, before we're obviously going to get into this in more detail, but CPI and PPI is consumer price index and producer price index. So it's how much goods and services cost for consumers and how much goods cost for producers. So this does not involve any printing of money, but it involves the increase of consumer goods due to the production costs increasing in price. So you've got to understand that as producers have higher costs, they're obviously going to push that on us as well, because they still want to make a profit, right? So the third type of inflation is built-in inflation. This is mainly due to speculation. So expectations that prices will continue to rise in the future. This has an impact on costs, wages, and etc., to deal with a high standard of living costs. So with speculation, speculation goes on in the market. For example, right now, the Fed are expecting that we're going to be tapering assets, right? And then eventually interest rates in the future. And what a lot of traders will try to do, and essentially the economy, they'll try to price that in before it even happens. So that's what we call the built-in inflation, where it's inflation that we're expecting to happen soon, but it's already been building up due to that speculation. And you guys, definitely take notes as we're going through here. And obviously look back just to understand this more. I'm going to be adding some more links into websites that you can read more and more into inflation, but even YouTube searches, if you still don't understand exactly what it means. But just the main thing is go back to this slide and actually understand what it means. Understand how inflation affects the currency. Does it value it or devalue it? What happens to the purchasing power? Does it become cheaper or more expensive for us? And then obviously the impact that has on exports and imports. Anyways, guys, take care, and I'll see you in the next video.